Welcome back to the last lesson in the futures series. In this lesson, we're going to break down how major economic events kind of like impact the futures market and how to train around them with awareness and control. We're going to talk about CPI, non-farm payrolls, all the way to FOMC, rate decisions, and PMI data. There are a couple more we're going to talk about. And so these reports can kind of move the market instantly, sometimes causing massive spikes in volatility. And we're going to explain what these news events are and how they impact the market. And so the goal of this lesson is for you guys to identify key news events, understand their impact on price action, and like adjust your trading strategy around them. And this is going to help whether you're trading the ES, NQ, bonds, gold, or any other contract. So first things first, in futures trading, economic events aren't background noise. They're actually primary drivers of market direction and volatility. So future contracts are often used by institutions to hedge or speculate on macroeconomic trends. What this means is reports that impact inflation, interest rates, or growth have a direct effect on how these contracts move. For instance, the CPI report impacts inflation expectation, non-farm payrolls influence views on labor strength and economic resilience, the FOMC rate decision is one of the biggest market moving events of the month, and so on. Markets don't just react to the numbers, they react to the surprise. There's a question of, was that data better or worse than expected? I'm going to show you guys a few things that will kind of help you see. So for instance, right here, this is just news for today. This is the news that are coming out on July 31st, 2025. You could see actual forecasted and previous news for whatever it is. So for instance, if we're looking at Chicago PMI, the actual one that came out is 47.1. The forecasted one was 41.9. So as you can see, B forecasts, and the previous one was 40.4. So understanding what event is coming, what's expected, and how the market tends to respond is a core skill, and it's not optional when you're trading futures. This whole lesson, we're going to talk about the most important types of news ones. I'm going to explain what they are, and then we're also going to summarize some other ones, and then we're just going to summarize the whole lesson, the whole series we talked about. So, types of news. So, the first one, and I consider the most powerful on the calendar, is the CPI, which stands for Consumer Price Index. So CPI measures the rate of inflation. It is how much prices are rising across a basket of goods and services. So the government tracks a basket of goods and services that most people regularly spend money on. These could be things like rent, groceries, gas, medical care, clothing, and so on. They check the prices each month and compare them to the previous month and to the same month a year ago. In futures, inflation data matters because it directly affects how the Federal Reserve manages interest rates. And rate policies is what drives everything from equity futures, these are like SE and NQ, to bond futures like ZN and even gold, which is GC. So, for instance, if CPI comes in hotter than expected, it signals persistent inflation, which means one, the Fed may raise rates or stay hawkish. And this, what it creates is a usually bearish for risk assets, especially tech heavy like the NQ. On the other hand, if CPI is lower than expected, it implies inflation is cooling. This means the Fed may pause hikes or consider easing, and this is often bullish for stocks and commodities. Future traders watch both the headline CPI and the core CPI, which is like what's it called, strips of food and like energy for a cleaner trend. And what will happen is you'll often seem extremely volatile at the release, with like initial spikes in both directions as algos and react to surprise numbers. And so knowing the release times, market expectation, and recent inflation trends, it can help you prepare your trade or step aside during chaos. Another big one that is actually coming out tomorrow is called NFP, or known as non-farm payout. And so it comes out every first Friday of every month, and it tells you how many jobs were added or lost in the US economy. It does exclude farm workers, government employees, and a few niche categories. So if you're new to trading, there are reasons it matters. The first one is the US economy runs on jobs. The more jobs you have, the more people with income. The more people that have income, there's more spending. More spending in the economy, it grows and boosts the economy, creating it stronger. And what it creates is, if you guys know macro 101, this is the GDP formula right here at the top. And as you're increasing your consumption and you keep investment, government spendings, and your export imports steady, your GDP will increase. And if GDP increases, it usually shows bullish in the market. Not necessarily, but it usually helps out. On the other hand, though, it's if we have fewer jobs, we have less income, less spending, potential slowdown because consumption decreases. So when the report shows a big increase in jobs, what it does is it signals economic strength. However, there is a twist. That could also mean inflation might rise because more people working, which means more demand and higher prices, and which leads to higher interest rates. On the other hand, if job growth is weak or unemployment rises, it could mean the economy is slowing down, which causes the Fed to ease up on rate hikes. So future markets react to this in real time. The ES and NQ often move sharply at the release. Also, bond futures like ZN, which is the 10-year note, or ZB, which is the 30-year bond, react to interest rate expectation, and even currencies and gold futures move depending on how the dollar reacts. And so the market doesn't just look at the job number. It also watches the unemployment rate, wage growth, which is like our workers earning more, and then revisions to previous months. And so all of this creates massive volatility, especially in the first 30 to 60 seconds after the release. And then it's still volatile for 5 minutes roughly after the news comes out, but then it dies down a little. And so for future traders, non-farm payrolls non-farm payroll days is one of the most important days of the month, and it's usually best to either prepare carefully or step aside until like the initial reaction settles. The next one is FOMC, and the Federal Reserve is the central bank of the U.S. And its job is to manage the economy by adjusting interest rates and controlling the money supply. I just want to get that out of the way because I'm going to mention it a lot. And so the Fed does this through the FOMC, and that stands for Federal Open Market Committee. And so the FOMC meets 8 times a year, roughly kind of every 6 weeks. And so at each meeting, they decide whether to, 1, raise rates, so this means tighten the monetary policy, lower rates, which stimulates the economy, or leave rates unchanged. And so what they do is they announce this through statements released at 2 p.m. Eastern Time, followed by a press conference with the Fed chair, which is currently Jeremy Powell. And so this decision and the tone of their messaging, which is very important, has a massive impact on markets. You may ask her, well, why? Well, because interest rates affect everything. If the Fed raises rates, borrowing becomes more expensive. It slows down spending, stocks usually fall, kind of like the previous NFP we talked about. If they lower rates, money is cheaper to borrow, it boosts spending, stocks often rally. Future market prices in expectations leading up to the meeting, so if the decision surprises the market, volatility explodes. You will also often see ES and NQ spike sharply, bond futures jump or drop based on rate sensitivities, gold and the dollar index also react. All these 4 react. What's also even more important is the actual rate decision is often the language used. So are they sounding hawkish, which means are they tightening, or dovish, which is supportive? So yeah, as you can see, this is just from investing.com. Traders don't just watch the numbers. What they do is they read every word of the statement and hang on every comment during the press conference. I'm going to show you guys something really quickly. So there's this site called Financial Juice. And if I show it to you right here, what you can see is, well, there's no FOMC right now, but you could see kind of the statements that they say word for word. Or even if Trump is speaking. I don't think Trump has spoken in a minute. Here you see Trump disagrees with whatever. But what this does is it tells you word for word. They quote people. I don't know. Maybe I can search up Trump. Let's do this quickly. Yeah, nothing much. But if Trump was to speak today, you would see it highlighted in red, and it would say what like the most important things Trump says. Anyways, back to FOMC. So that's why FOMC day is one of the most volatile days in futures trading. And it also requires like extra cautious, especially during the window it's open, with the window released, and like 30 minutes after, so 2 to 2:30, I would say. The next one is PMI, also known as Purchasing Managers Index. So it is one of the most best early indicators of how the economy is performing, especially in terms of business activity and confidence. It's released monthly, and it reflects how purchasing managers, so the people who order raw materials and supplies for companies, are feeling about the company. Sorry, are feeling about the economy. There are actually two main PMI reports traders watch. The first one is called the Manufacturing PMI, which tracks factory and production data. And there's also Service PMI, which looks at industries like finance, tech, healthcare, and consumer services. Both are surveys. They ask managers questions like, are new orders increasing or decreasing? Are prices rising? Are supply chains improving or slowing? And the results are scored on a scale. A reading above 50 means economic expansion. A reading below means it's a contraction. So for instance, let's say we have a PMI of 48.5 right here. That signals the economy is slowing. And if services PMI jumps to 55, it means growth. Well, I guess 50.3 in this case. Let's say 50.3. Well, why does it matter for futures traders? Well, because PMI is forward looking. It gives clues kind of about like the economic health before hard data like GDP or earnings come out. And so that's why institutional traders watch it closely. And future markets often move sharply if numbers surprise it. Let's say if PMI is stronger than expected, it can boost ES and NQ, especially if inflation looks stable. But if it's weak, it might signal recession risk, causing risk-off reactions and lifting bond futures like ZN or safe havens like gold. Also, PMI doesn't always create instant volatility like CPI or NFP, but it's like a powerful trend signal, especially when it shows a clear direction change. JOLTS. So the JOLTS report is short for Job Openings and Labor Turnover Survey. It tells us how many jobs are currently available in the U.S. economy. Unlike the NFP report, which shows us how many jobs were added, JOLTS focuses on how many employers are hiring but haven't filled the position yet. It also gives insights into how many people quit their jobs, which is voluntarily, and how many were hired or laid off. If job openings are very high, let's say, that tells us companies are trying to grow and hire, but maybe struggling to find workers. Sorry, that was my dog. That kind of tight labor market puts upward pressure on wages, which can feed inflation. The Federal Reserve watches this report closely, especially the total number of job openings and the quit rate, which is people quitting, which usually means they're confident they can find something better to do, or I guess a better job. Another question, how does it affect the futures market? So if job openings come in much higher than expected, the market might interpret this as like a sign that labor market is still hot. The Fed may need to stay hawkish to control inflation. That is typically bearish for ES and NQ. Bond yields rise and bond futures usually drop. On the flip side, if job openings fall or the quit rate drops, it might signal that the economy is cooling, which leads to traders to expect a softer Fed stance, kind of, if you know what I mean. And so while JOLTS doesn't always create instant volatility, it's often like the tiebreaker between other labor reports. So for example, like if NFP is strong but JOLTS is soft, the market may rethink its assumption about the strength of the economy. I don't know if you guys understand that, but yeah. So how to prepare for economic events as a futures traders. At this point, you should understand that economic events can move the futures market in a matter of seconds. So that's why preparation is essential. It's not optional. First, get into the habit of checking the economic calendar every single day before the market opens. You would want to know what reports are coming out, what time they'll be released, and what the market is expecting. I'm going to give you an example. You go on investing.com, for instance. You go to their economic calendar, and you have everything for today. So this is what's coming out today. Today, scroll down. The stock market opens at 9:30, so we're gonna go to 9:30. Nothing crazy. We had Chicago PMI come out at 9:45. This not as important. We didn't see much because the market actually tanked today, but it's increased. But yeah, so you can see this. You can also see what's coming out tomorrow. Tomorrow is a very important one, like I mentioned, is coming out. So tomorrow, PMIs. We have S&P Global PMI, and then we also have NFP. I cannot find it. There you go. There you go. Non-farm payrolls. So two very important things are coming out tomorrow. So tomorrow is going to be a volatile day probably. So yeah. So even if you don't trade the news itself, these events affect, like I said, volatility, direction, volume, especially in contracts like ES, NQ, ZN, ZB, GC, and so on. So also, for example, like if CPI is coming out at 8:30 a.m. and you are trading at 8:28, you're gambling because the initial spike might blow right through your stop loss, even if you're right on the setup. Also, you should remember the market doesn't just react to the number, it reacts to the surprise. Don't look at the headline and ask, was this better or worse than expected? Was it hotter or cooler? If it was worse than expected, but the market still rallies, that tells you something about the underlying sentiment or positioning. So what happened today? The rule is volatility amplifies around news. If you're going to trade it, reduce your size, but it's better to wait for the reaction and the retest when things like kind of settle down and structure returns. Also, you should never ignore macro just because you're trading technicals. And in futures, price action is like a reflection of macro expectations, like events like CPI, NFP, FOMC, and it's what reset those expectations. You should also trade with context. Like the more you understand how news moves the market, the more control and confidence you have in your setups. A couple other ones I did not mention. Beyond these like ones, there is initial jobless claims, which comes out every Thursday, and it provides like a real-time look at how many people are filing for unemployment. And it's not as impactful as NFP, but it can move markets when the labor market is in focus. You got retail sales, shows how much consumers are spending, which is like a major piece of economic health since consumer activity drives 2/3 of the US GDP. As a strong like number, here often lifts ES and NQ, while weaknesses raise recession concerns. Recession concerns. You got PCE, which is personal consumption expenditure, is the Fed's preferred inflation gauge. It's similar to CPI, but with like different weighting. It's weighted differently. A surprise here can usually lead to sharp market moves, especially if CPI is already hinted at inflation pressure. You also have this ISM report, which are like PMI, but produced by different groups. These traders watch these closely when PMI shows conflicting signals. You have GDP releases. These are quarterly. They show total economic growth and often confirm or challenge the direction market's already moving. So yeah, so you don't want to overlook consumer confidence, especially when volatility is tied to sentiment. You got outside of scheduled data, so geopolitical shocks like wars, elections, or unexpected rate hikes. The most recent one was the bombing on Iran. You have earnings season. Big moves in tech or banking names can swing index futures like ES and Q even without economic news. Recently, Nvidia beat earnings. Pretty sure Tesla also beat earnings. I don't remember. But yeah. Oh, also the takeaway. I always forget the takeaway. But even if you're not trading every report, I think staying informed helps you manage risk and avoid being blindsided by volatility. So that's kind of like the takeaway from this lesson. And so kind of to wrap up the whole thing, you've learned what futures are, contracts are. We talked about how they compare to stocks, ETFs, bonds, why institutions and traders use them every day. You've seen how to read a contract, how to understand tick value, margin, and sizing, and how to protect yourself with proper execution. We studied live trades, explored order flow, and learned the difference between breakout and pullback entries. You now understand that a trade isn't just a setup, it's a full decision-making process that includes environment, timing, structure, and context. If you don't remember what environment is, it is news, what this lesson was about. And you've also seen how macro events drive futures volatility and how to prepare for them instead of getting blindsided. And what I would say is the next step is practice. You should control through practice. You don't have to trade every day. You don't have to trade big, but you need to build reps. You got to study reactions and develop the confidence to act when everything lines up. Futures trading is fast, flexible, and powerful. And now that you have these tools to approach it with real structure, now, as I close off this series, I do want to mention that this was just educational. None of the things I said, especially in the most recent videos, are strategies of how to trade. A couple of them are indicators that help you trade, like the PMI. Sorry, not what am I saying? Not the PMI. VWAP and EMA. Those were a couple of things I talked about. But to actually trade, there you gotta go more in depth. You gotta do some research online. You can learn ICT, which looks at multiple sessions. So you can look at the Asian section, Asian market, sorry, the Asian time or in the London time, and then look at this one, and you look at highs and lows throughout different time zones. That's a whole different like built on futures. You could look through options, which is like hedge pressure and stuff like that. You could look at resilience. There's all of these different techniques of how to actually trade futures. So if you actually want to learn how to trade futures with indicators and like stuff like that, I guess this is not really what I was teaching. So you should just go on YouTube and search up ICT. I really like my personal favorite people who trade is Trades by Matt. I really like Rocket Scooter. Um, those are my two favorite ones. They don't trade ICT. There are people who trade ICT. It's just it's everybody does it. But if you really like, if you actually want to learn from a person who does with macro and like proves everything and has like a good setup, I really suggest Rocket Scooter. I learned a bit from him and then built on with my own stuff. But yeah, I hope this future series did help out a lot. And the next series coming out will be options. We're gonna talk about options, maybe not in as much detail as futures. Actually, we probably will end up, but yeah. Hope you guys enjoyed this video and this series, and we'll stay tuned for the next one. Thank you.